It was a roller coaster ride on Wall Street yesterday. The market jumped 200 points in early trading after the July jobs report was better than expected. The unemployment rate even dropped slightly to 9.1%, but 30 minutes later the market plummeted 200 points after investors' enthusiasm gave way to fear about the broader economy. By the end of the day, the Dow closed a little to the positive, up 60 points from Thursday's massive 512-point plunge. Now we're throwing a lot of numbers at you, but take a look at how this breaks down. Over the last 2 weeks, some $940 billion worth of investors' wealth has been wiped out. The average 401k lost nearly $12,000. This past week was the worst week on Wall Street in nearly 3 years. And on the same day, for the first time ever, the country's credit rating was downgraded. Just hours after the markets closed, credit rating agency Standard & Poor's cut the U.S. rating from AAA to AA+. The agency says the debt reduction plan passed by Congress last week didn't go far enough. This could affect everything from interest rates to the stock market come Monday.
So what does all this mean right here at home? And here to sort through it all is George Wells, president and founder of Auburn Hills-based Legacy of America wealth management firm. Good morning. Thanks for coming in.
Good morning.
Early on this Saturday morning. So let's start with this credit rating and this downgrade. And what does it mean for the average consumer?
Well, Michael, this is this new normal that we've been talking about, where we're seeing these fluctuations and we're seeing this volatility. Even with the downgrade in the credit rating, the United States is still the best gig in town. But personally, what this means for people is being much more vigilant. Last time when things were downturning, people would say, stay calm, relax, this is just a phase that we're going through. But now more than ever, you must be vigilant, reviewing every detail of your spending, of your saving, what I like to refer to as getting your house in order so you're prepared to weather these storms of what's going to happen next.
So do we pull money out of the market or kind of stay the course? Or I guess it really depends on how old you are and where you're going.
That's just it. Pulling money out of the market or leaving it in, if you have 10 years or more to save, the key is to be saving. Because even though it's important to make wise choices with what you have saved, if you don't have the seed there or if you don't have the money there, it really doesn't matter. And if you're close to retirement, if you're within 5 to 10 years of retirement, if you haven't put things in order by now, don't be asleep at the wheel on this one. Make sure that you're putting things in order and make sure that you're not allowing what's happening with the market to affect your livelihood going into retirement.
We've seen some wild numbers this week. What do you expect to see perhaps on Monday, Tuesday, Wednesday, or is it really anybody's guess at this point?
Well, it's anybody's guess, but I think the careful preparation is being prepared for things to continue to slip further. No one really knows what's going to happen next, but this is really alarming that the market has dropped so much, and really, but it's more of confirmation that this is the new normal, higher levels of volatility, higher levels of movement with money, but the important thing to be aware of is when money leaves one place, it goes to another place, and where is that place? So now more than ever, you want to make sure that you're utilizing some of the tools that are available, some of these absolute return funds that you have, that you're able to take advantage of markets in any direction.
A lot of people talking about gold these days. Good investment?
Gold is good in moderation. Gold has run up a lot over the last few years, but historically it hasn't gone up as much. So in moderation. Don't put all your eggs in one basket.
Real quick, a lot of people thought that things would kind of settle down once Congress and the president reached a deal on the debt ceiling, but it hasn't really been the case.
Yeah, I don't think people really believe that things are settled down that much. We would like to believe that they're settled down, but we know that nothing is going to substitute a good old-fashioned making wise choices with money that's going out, making wise choices with your savings, and finding innovative ways to progress forward.
All right, George Wells, thanks for coming in this morning. We appreciate it.
Thank you.
All right, over to Anu.
All right.